Welcome back. A bunch of stocks doing well, a lot of them not doing well, but that's about the secondary markets. But let's talk about the primary markets, and a bunch of IPOs have been coming about. And this one comes in from the integrated facility management and business services space. We have Updater Services, 640 crore IPO, opens for subscription. It's a near 400 crore fresh issue. Raghu Tangirala, the chairman and managing director of the company, now joins in. Thanks a lot, Raghu, for joining in, and congratulations on launch of the IPO. I've been looking at your business, and over the last 3 years or so, there has been a change in the way your revenue mix has shaped up. Earlier, a lot of the business would come in from the integrated facility management, and now we have increased contribution coming in from business services as well. Could you, for the benefit of our viewers, tell us if there is any margin differential between these two verticals, and going forward, what is the ideal revenue mix between IFM and business services?
First of all, thank you for having me. Good thing you asked me that question. Yes, as a strategy, we kept moving from the integrated facilities management to other business services, which I could briefly tell you what are the other businesses we have. But to answer to your question, yes, we did move. Our revenues have remained the same ratio last 2-3 years, which is about 60 to 70% is integrated facilities management, and about 30% would be business services. Facilities management basically is a scale game, and we make around 5% EBITDA margins. In the business support services, it's about anywhere between 12 to 15%. So as a blended, we do about 7% EBITDA. So this is what is it. Going forward, I think the next 2-3 years, this ratio will remain the same. 70-30, that is 70% integrated facility, we call it IFM, and then 30% would be business support services, because both are growing at about 20%, so the ratio would remain similar.
Got it. All right. Hi, Mr. Tangirala. Good morning, and thanks so much for speaking to us here on CNBC-TV18. Well, you have explained that perfectly to us, so that's good on the operational front. Now, you're raising some money, and some part of that will be going to you, the PE investor, as well as the company. Now, the money goes to the company is going to be used for debt repayment. I think your debt was not very, very large. So post the IPO, what does the debt number come down to? And also the promoter entity holding comes down to 58.5% odd. Do you think you'll be comfortable at these levels, or would you like to further bring it down in the time to come? Because you've abided with those laws, sub 75%, you've done it pat with the IPO itself.
Good that you asked me. Yes, we would... not dilute further. We've already, a promoter will be about 58-60%, and will remain that for some time. So I have no plans to dilute further. And in terms of the fresh issue, we are raising 400 crores. Out of 400 crores, about 130 odd crores goes for retirement of debt, and about 110 crores for augmented working capital, which is for future working capital, and about 80 crores for in the blind pool, which would go for inorganic, and 70 odd crores for general purpose. So this is broadly the construct for the primary.
So you'll be in net cash then post this IPO?
No, just to add there, we're already there's no debt. We have only a net debt of 10 crores. I'm talking pre-issue. So we would be cash surplus. We are already only 10 crores net debt.
And inorganic growth, that's roughly around 50-80 crores, right? Is what you have earmarked. So by how soon should we be looking at some inorganic growth? And it'll be in which segment? The BSS segment?
Absolutely right. It's only in the BSS segment. We would not do anything in the facilities management that we could grow ourselves. So it will be in the BSS segment, could be in the audit and assurance or sales enablement. This is one of those business segments.
All right, that's pretty specific in terms of your want from an inorganic. So that gives me a sense that you're already in touch with people. So can we hear of something in the first year of your operations in the secondary market itself?
Of course.
You have the money, you have an idea of what you want, and perhaps there is a plan.
There is a definite plan, but we don't have a target right now.
Okay, let's talk about your business going forward itself. You said both your verticals are growing at around 20-odd%, and that explains why the ratio remains this 70-30 mark. That's organic. With inorganic coming in, what is the sort of growth that you're anticipating? What is the size of companies that you're looking to buy? And how much could that add to your overall revenue going forward?
Roughly, I can tell you, since we don't have the target right now, we would do roughly about 25 to 30 crores of additional EBITDA. That will be the pie. I don't know the pricing because we don't have the target. But the strategy is to add about 25, 30 crores of EBITDA year on year by inorganic.
Okay, 25 to 30 crores of EBITDA every year by inorganic, 20% growth is what you're eyeing organically. And, in terms of margins, because you're adding more EBITDA, and most of that is coming in from the BSS vertical itself, which has a higher margin. I just wanted to understand, what is the outlook for your margins going forward? Last 3 years, they've been between that 6 to 8%. Is this the band one should look at, or do we see them structurally moving higher?
Absolutely right. That is the band between 6 to 8%. But what we would want to do, what we are working on is about moving this at about 25, 30 points every year. That means every 3 years we add a 1% to our EBITDA. This would happen largely because we can't pull price, but we can definitely have two levers of our own operational efficiency. So that's the only way we can improve the EBITDA. We are targeting something close to about 1% every 2-3 years improvement.
All right, sir. Typically, for a business like, in terms of inorganic growth, what kind of multiple do you pay normally? Because you're talking about adding 25 crores odd. So on that, what kind of a multiple? 4 times, 5 times, 6 times? I mean, just give us a broad idea. Typically.
It could be in the range of 5 to 7 times. We don't know the target, so we don't know the multiple. But to give you historically what we've done, if you look at last 3 years, we have acquired significantly about, we have spent, capital employed about 200 odd crores for our acquisition. And if you not believe, last year we had these companies delivered 100 crores EBITDA.
Got it. What we're trying to get at is, if you're looking at getting a company with an EBITDA of 25 crores, at 5 times multiple will be 125 crores to around 175 crores. That could be the broad number that we could be looking at if in case there is some inorganic growth. It's been good speaking to you, sir. Thanks so much for stopping by, explaining the business aspects to us. We wish you well with regard to this IPO. And on listing, we'll have you back with us and we'll get to some specific numbers in the near as well as the longer term.